Today, we're diving into tip number 5, stay informed. If there's one thing I've learned over the years trading markets around the globe, it's that information isn't just power, it's survival. The markets move fast, and they react to a web of influences, from central bank decisions and economic data to corporate earnings and geopolitical events. Being plugged into these developments isn't optional, it's a necessity if you want to trade successfully. Think about it this way. Imagine you're driving a car blindfolded. You might know the road a little, but you can't react to sudden changes, a stoplight, a pothole, a curve. Trading without staying informed is exactly like that. You can make educated guesses, but without real-time knowledge, you're taking unnecessary risks. Even rumors can move markets dramatically, and sometimes, the speed of information is what separates profitable trades from devastating losses. Let's break it down by the type of trading. In Forex, for instance, currency pairs are extremely sensitive to economic data and geopolitical developments. Non-farm payroll numbers in the US, central bank interest rate decisions, political instability, these all can cause sharp swings in exchange rates in minutes. I remember one morning back in 2019, the Bank of England unexpectedly signaled a potential rate cut. GBP pairs reacted almost instantly. Traders who were monitoring the news were able to adjust their positions or step aside, while those who weren't lost significant amounts within hours. Stocks are no different. Corporate earnings, mergers, acquisitions, or even rumors of management changes can move share prices dramatically. Broader economic indicators like GDP growth, employment data, or inflation reports often shift market sentiment, affecting stocks across sectors. Commodity traders also feel these effects. Oil, gold, agricultural products, all are influenced by supply and demand dynamics, political tensions, and global economic health. Understanding the distinction between short-term and long-term effects is also crucial. Some news triggers immediate volatility. Think of a surprise interest rate announcement or an unexpected earnings miss. Other developments, like shifts in government policy, trade agreements, or demographic trends, can reshape market conditions for months or even years. Recognizing the difference helps traders decide whether to act quickly or plan for a long-term strategy. Let me share a real-world case study that illustrates this perfectly: Brexit. The United Kingdom's decision to leave the European Union in 2016 created one of the most volatile periods in Forex history. On June 23, 2016, the referendum results were announced, and the British pound plunged from 1.48 to 1.32 against the US dollar in just a few hours. Traders who had stayed informed and monitored developments could react immediately, adjusting positions, using stop-loss orders, or hedging their exposure. Those who ignored the news suffered significant losses. But the story didn't end there. The months and years following the referendum continued to generate volatility as negotiations. Political statements and economic updates shaped the pound's trajectory. Every new announcement led to price swings, and traders had to adapt continuously. Some used hedging strategies, others adjusted risk management approaches, and all who stayed informed had a better chance of navigating this turbulent period successfully. So, how do you stay informed without becoming overwhelmed? First, rely on reputable news sources: Bloomberg, Reuters, CNBC, the Financial Times, and similar outlets. These provide timely, accurate information. Next, economic calendars are invaluable. They give you a schedule of upcoming data releases, interest rate decisions, and policy announcements, along with expected market impact. Knowing when events are scheduled allows you to anticipate volatility rather than react blindly. Social media and financial forums can be useful too, but with caution. Platforms like Twitter often deliver news faster than traditional outlets, and you can gauge market sentiment in real time. Just remember, not everything is verified. Always cross-check before making trading decisions. Finally, consider analytical tools and paid services that provide forecasts and in-depth insights. These can help you interpret data and identify potential trading opportunities before they're widely recognized. Here's a quote from Jesse Livermore, one of the most famous traders in history, that captures the essence of this tip: the market does not beat them. They beat themselves, because though they have brains, they cannot sit tight. Staying informed helps you sit tight when you need to, and act decisively when the opportunity is clear. From my personal experience, traders who actively track economic events and news consistently outperform those who don't. I've seen traders miss entire market moves simply because they weren't paying attention to central bank statements or global developments. Conversely, informed traders can position themselves, adjust risk, and even profit from volatility. Staying informed allows you to manage risk proactively, rather than reactively. Now, for a question to get you thinking, and I'd love for you to comment below this audio: what's your strategy for staying informed? Do you rely on news aggregators, social media, newsletters, or a combination? And how do you decide which news is actionable versus noise? Sharing your approach not only helps you clarify your own method, but it also provides insights for others navigating the markets. To sum up, tip number 5 is all about vigilance and adaptability. Financial markets are constantly shifting, and the ability to interpret news, anticipate reactions, and adjust your strategy is what separates successful traders from the rest. Use reliable sources, track economic events, leverage tools for analysis, and maintain awareness of both short-term and long-term implications. Knowledge isn't just power in trading, it's profit. Staying informed keeps you prepared, keeps you ahead, and ultimately, keeps you in the game.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!